Can we trade cryptocurrency in the United States without paying taxes on it? Oh, that indeed would be a dream come true. The good news is that there is a way. However, there are some trade-offs. Hello, I'm CryptoCasey, and in this video, we are going to explore how we can actively trade cryptocurrencies all day, every day, as many times a day as we want without paying taxes on the trades legally through a tax-sheltered retirement account like an IRA or Roth IRA. I get a ton of requests from you guys for recommendations on crypto IRAs and retirement accounts, and I finally had some time to do some digging. So stick around till the end of this video where we talk about the crypto IRA platform I decided to go with for my own personal retirement accounts and feel comfortable enough sharing with you to research and check out as well. If you find this type of information interesting and helpful, please let me know by liking the video and subscribing to my channel for more crypto content. Also tap the bell notification so we all stay up to date on the latest happenings in the crypto space together. Cool. Before we get started, please note that there are a ton of scammers in the crypto space impersonating educational content creators like myself, making duplicate social media accounts and profiles to ask you to send them funds to invest on your behalf with the sole intention of never sending anything back to you. So check out this list of my only official social media accounts where I will never ever engage in direct messaging, never ask you for money, never ask you for crypto, never ask you to install profit-generating software on your computers or devices, or anything remotely similar. You can access the correct and official and only social media accounts I have by scrolling down and clicking on the links in the description area below. Any profile or contact not listed in the description area is not me. So beware and stay vigilant during these crazy times in crypto. Awesome, let's learn about how we can trade crypto tax-free using retirement accounts. Just a heads up for everyone, I'm not a certified public accountant, so I highly recommend consulting one with any tax-related questions that may arise as we explore tax-sheltered retirement accounts in this video. Cool. So when we trade on exchanges like Coinbase, Crypto.com, Kraken, Gemini, or even when we use DeFi or decentralized finance related activity using Uniswap, Ava, and similar, a lot of taxable activity is occurring. Let's go over a few different types of crypto transactions and the potential tax implications related to them. Trading cash for crypto. When you trade fiat or cash like the US dollar for crypto like Bitcoin, Ethereum, or any other cryptocurrency, this is not a taxable event. So if you buy $10 or $100 or $1 million worth of Bitcoin using cash, you do not have to pay any taxes on that transaction because it is not viewed as a taxable event. So you can buy with cash or fiat any crypto whenever you want, however often you want, and you're good to go on the tax front. Now, when you choose to trade the crypto you bought for another crypto, or when you choose to sell that crypto for another crypto or for cash, that is a different story. Trading crypto for cash. When you trade any crypto like Bitcoin, Ethereum, or any other cryptocurrency for fiat or cash like the US dollar, that is a taxable event. There are three categories of variables that affect the tax implications of a crypto to cash trade. One is the length of time from when you first bought the crypto to when you sold it. Two, whether the price you bought the crypto at was higher or lower than when you sold it. So basically if the crypto to cash trade was a gain or a loss overall. And three, the valuation methodology you elect to use to evaluate your cost basis when selling the crypto like LIFO versus FIFO versus HIFO. Whoa, what the heck does all that mean? Well, let's break down these three categories together step by step. Short versus long-term capital gains. The date that you buy a cryptocurrency with cash and the date that you sell that cryptocurrency for cash is a factor that determines how the transaction is taxed. If you sell the cryptocurrency for cash less than 12 months from when you bought it, the transaction is subjected to short-term capital gains, which is your regular income tax. For example, let's say your annual income is between $41,000 and $86,000 per year. In the United States, at the time of this video, that puts you in the 22% taxable income bracket, meaning that any amount of money you receive up to around $86,000 in a year, you owe 22% of it to the IRS in the form of income tax. So if you bought $1,000 worth of Bitcoin and then the value doubled to $2,000 and you sell it in less than 12 months from the date that you bought it, you would owe the IRS taxes on your $1,000 capital gain based on your income tax rate of 22%. In the US, depending on how much money you make per year, you could be in the 10, 12, 22, 24, 32, 35, or even 37% tax bracket. Most of us tend to be in the 22% plus tax bracket, which is important to note when considering short versus long-term capital gains. Because if you sell crypto for cash in less than 12 months, you pay whatever your income tax rate is. While if you sell the crypto for cash more than 12 months after you bought it, you only have to pay the long-term capital gains tax rate, which is generally 15%, but it could also be 0 or 20% depending on your taxable income and filing status. Either way, long-term capital gains taxes of 15% tend to be lower than short-term capital gains taxes, which is your income tax rate. Taxable gains versus losses. When you sell a cryptocurrency for cash for higher than you bought it, you realize a gain, which you owe taxes on. If you realize the gain in less than a year of holding the crypto, you owe the IRS whatever your income tax rate is. If you realize the gain in over a year of holding the crypto, you owe the IRS long-term capital gains, which is generally 15%. Again, this tends to be a lot less than your income tax rate. So while crypto gains are taxable, when you sell a crypto for less than you originally bought it, you suffer a loss. Fortunately, the IRS does allow investors to use losses to reduce their tax liabilities, or in some cases, can lead to a tax refund. Either way, if you are an active crypto trader, gains and losses are occurring throughout each tax year. And as if it couldn't get more complicated, valuation methodology. The valuation methodology you elect to use to evaluate your cost basis when selling the crypto, like LIFO versus FIFO versus HIFO, is another complicated aspect that determines your tax liability each year. And to avoid losing sight of the purpose of this video, we are going to leave a breakdown of that concept for another video with an actual certified accountant. All you need to know, which you've probably gathered up to this point, are taxes are a challenging, necessary evil that crypto trading, unfortunately, makes even more challenging. Here's why. Trading crypto to crypto. When you trade crypto for another crypto, a lot of taxable events occur. Whatever you initially bought the crypto for using fiat or cash is an element that is considered whenever you trade that crypto for another crypto. So let's say you bought $100 worth of ETH. And by the time you decide to trade it for another crypto, like Cardano, the $100 of ETH is now worth $150. The $100 of ETH that increased in value to $150 that was then converted to Cardano, you owe capital gains taxes on that $50 gain. And depending on how long you held that ETH, that tax could be your income tax rate or the long-term capital gains tax rate. And now this $150 worth of Cardano, if it increases to $300 and you convert it back to ETH or any other crypto, you owe taxes on those gains as well. So whenever you buy and sell crypto to crypto, depending on what you bought it for and what you sell it at, lots of gains and losses are realized, which all need to be accounted for and filed with the IRS in your tax return. Yikes. But wait, there's more. Staking rewards and interest income. Any rewards you receive from staking, airdrops, interest from lending or providing liquidity to liquidity pools, mining, any extra crypto you earn from participating in and interacting with DeFi protocols, or from regular centralized exchanges is all taxable income. So you have to pay whatever your income tax percentage is on any and all income from the aforementioned activities. And the ever-changing price of all those cryptocurrencies is at play tax-wise as well when you earn them, trade them for other crypto, or sell them for cash. Nightmare city, right? Yes, that is why I highly recommend seeking out a qualified CPA or accountant to help you file your taxes. And if you're wondering how on earth you'd be able to provide all the DeFi trading activity you've done on decentralized financial applications like Uniswap, QuickSwap, Ava, Curve, and similar, you're in luck. Check out my video guide for beginners that walks you through a quick and simple way to retrieve all that information to help you and your accountant file your taxes by clicking on the link above. And if you want to calculate and file your taxes yourself, I highly recommend checking out Token Tax. Their platform connects to both centralized and decentralized exchanges and applications, which makes the process automated, simple, and relatively painless. So scroll down to click on the link in the description area to access the correct and official site, all while supporting the channel. Amazing. So I know some of us did experience some gains last year, which the IRS will be keen on taking their fair share of. And now that we have a clearer idea about how unclear and crazy crypto trading makes the whole tax filing process, there is a silver lining among all those dark, stormy clouds we just ventured through together. Let's learn about how we can legally trade cryptocurrency using tax-sheltered retirement accounts like IRAs, Roths, 401ks, and similar. Tax-free retirement accounts. Within a tax-free retirement account, there is no federal or state tax due or owed on any income earned in the account. and there is no federal or state tax due or owed on any distributions or withdrawals of that income. A tax-free retirement account includes a Roth IRA and a Roth 401k. So if you have a Roth IRA, you can only put income that you earned into that account, and that money you initially put into the account is taxed. Once the money is in the account, you can trade 1,000 times a day, make ridiculous gains, and not owe any capital gains taxes or income taxes on it. Sweet, right? Well, Roth IRAs do have restrictions like the amount you can contribute within the scope of a year, which is $6,000. But if you're over 50, you can contribute a maximum of $7,000 per year. There are also limitations on who qualifies for a Roth IRA account, and this is based on your household income and filing status. Basically, if your annual income is too high, you will not be able to open a Roth IRA or Roth 401k account. Also, any income and gains generated in the account can be withdrawn tax-free only after you reach a certain age, which at the time of this video is 59 and a half. Also, if you become disabled or are using the funds as a first-time homebuyer, you may be able to withdraw the funds without a penalty as well. If you want to withdraw the funds earlier, you would have to pay a penalty plus income tax on the funds. So you can see that it's not for everyone, but definitely worth considering from a wealth management and retirement planning standpoint. There are many other factors related to opening and managing retirement accounts. So again, I highly recommend seeking financial advice from qualified advisors as well as accountants to help you make the best decision for your unique position in life. Tax-deferred accounts. Within a tax-deferred account, there is no federal or state tax due or owed on any income until you take a distribution or make a withdrawal. A tax-deferred retirement account includes a traditional IRA or 401k. So if you have a regular IRA, you can only put income that you earned into the account, and that money you initially put into the account is tax deductible. Meaning, for example, if you made $6,000 in crypto gains in a year and also contributed $6,000 to a traditional IRA, then you get to use that contribution to reduce the amount of taxes you owe from a percentage of that 6K gains to 0. Nice. So once the money is in your traditional IRA account, you can trade 1,000 times a day, make ridiculous gains, and not owe any capital gains taxes or income taxes on it until you make a withdrawal. So basically, you get a tax deduction on any money you contribute upfront, but once you retire, you have to pay income taxes on the amount you withdraw. IRAs have restrictions like the amount you can contribute within the scope of a year is $6,000, and if you're over the age of 50, you can contribute a maximum of $7,000 per year. Also, any income and gains generated in the account can be withdrawn only after you reach a certain age, which at the time of this video is 59 and a half. If you want to withdraw the funds earlier, you would have to pay a penalty. So again, you can see that it's not for everyone, but definitely worth considering from a wealth management and retirement planning standpoint. So at the time of this video, there are not a lot of dedicated crypto retirement account service providers and not a lot of long-standing retirement account providers that support cryptocurrency custody or trading. Fidelity, Vanguard, all the big traditional institutional players are still way behind. So after some research and consideration between providers like Choice, Bitcoin IRA, Coin IRA, Bit IRA, and similar, iTrustCapital seems to be the superior crypto IRA platform in the United States at the time of this video. So if you would like to check them out, you can access the correct and official site by scrolling down and clicking on the link in the description area below. Here are a few reasons why I decided to give iTrustCapital a go. They've got the lowest transaction fees of all the other competitors, which is awesome when you want to trade to your heart's desire without the tax implications. Their crypto transaction fees are 1%, and their monthly annual account fee is non-existent, $0, which is pretty amazing when you consider all the ridiculous fees associated with traditional retirement accounts and actually some of those other crypto retirement accounts. Another reason I decided to go with them is where and how they store their crypto. If you guys frequent this channel, you know how much I hound you guys on getting hardware wallets to store your crypto long term. iTrustCapital uses institutional grade crypto custody through Coinbase Custody, which is the leading institutional cold storage provider, as well as Fireblocks, another top institutional custody provider that can access DeFi or decentralized protocols. This means that very soon, iTrustCapital will be the first and only cryptocurrency retirement provider that will be able to support staking as well as other cool DeFi related activity. So all staking rewards and similar you accumulate in your retirement account, depending on whether you qualify for a Roth versus a regular IRA, will be tax-free or tax-deferred. Right now, any staking, lending, or liquidity you provide with BlockFi, Voyager, and similar are all treated as taxable income. So DeFi within a retirement account will be exceptionally interesting and beneficial for us from a wealth management standpoint. If you do your own research on all of the crypto retirement companies out there, you'll find that iTrustCapital has been around a while and is the main trendsetter amongst their competitors and is highly innovative. At the time of this video, they support about 27 different cryptocurrencies. However, with their connections with Coinbase Prime, they will be able to quadruple the amount of cryptocurrencies available over the next few months. Nice. So a couple of cons versus the pros I noticed so far is lack of good tools for metrics, like lack of line graphs, pie charts, and similar. However, supposedly, more crypto portfolio tracking metrics are in the works for Q1. We shall see. Also, for all of you living in New York and Hawaii, unfortunately at the time of this video, iTrustCapital is not available. But allegedly, they are currently jumping through the necessary hoops to overcome that. Another double-edged sword is that their minimum to open an account is $2,500. So sure, that is a barrier for some to participate at this time. However, it does make for a more responsive support team that they purport responds to help with tickets within 24 hours. We shall see about that as well. As I recently fully funded the $6K maximum in a regular IRA account with iTrust for 2021 tax deduction purposes, and to test them out for the long term. So if you're interested in following my trading journey within my crypto IRA account and continued experience with choosing iTrustCapital over other competitors, please make sure to subscribe to my channel and click on the notification bell to stay updated. And again, if you're interested in checking them out for yourself, scroll down to the description area below to access the correct and official site, all while supporting the channel. Awesome. Thank you so much for taking the time to watch this video. If you enjoyed it, please make sure to like this video and subscribe to my channel for more crypto content. So what do you think about crypto retirement accounts? Did you know that tax-free and tax-deferred crypto trading existed? Are you going to hit the books and see if a crypto IRA is a good move for you? Let me know in the comments below. Be safe out there.